Hello, friends, and welcome back to Seniors Radio. If you are listening to this broadcast today, it means you are likely approaching your 65th birthday, or you have just turned 65 and you are still in the workforce. Maybe you never planned to retire at 62. Maybe you love what you do. Maybe, like millions of other Americans in 2026, you looked at the cost of groceries, the price of heating oil, and the reality of your 401k balance, and you made the responsible, hardworking decision to keep earning a paycheck. There is absolutely no shame in that. You worked hard for 40, 45, maybe 50 years. You paid your taxes, you contributed to the system, and you deserve to work as long as you want. But if you have already filed for Social Security, or if you are planning to file right at age 65, I need you to drop everything and listen to me very closely for the next hour. Because there is a massive, brutal, and completely unforgiving rule in the Social Security Code that specifically targets people in your exact situation. It is called the Retirement Earnings Test, and specifically the $1 for every $2 withholding rule. If you are 65, still working, and collecting Social Security, the government is watching your income, and if you cross a very specific, very hidden line, the Social Security Administration will not just reduce your check. They will literally withhold it. They will stop sending you your money month after month until they have clawed back every single penny of the penalty, and they will not call you to warn you. They will not send you a polite letter asking if you meant to earn that much. They will just take it. Today on Seniors Radio, we are doing a complete, exhaustive, one-hour masterclass on exactly what happens when you are still working at 65. We are going to break down the $1 for every $2 rule. We are going to look at the exact math. We are going to talk about what counts as income and what doesn't. We are going to expose the traps for self-employed individuals, and I am going to give you the exact strategies to legally protect your paycheck. Before we dive into the deep end, if you are not subscribed to Seniors Radio, please take 3 seconds right now to hit that subscribe button and turn on the notification bell. The rules around Social Security, the earnings limits, the Medicare thresholds, they change every single year. The SSA does not send you a manual when the rules change. They just change them. What we do here on Seniors Radio is translate those changes into plain English so you never lose a dime to a rule you didn't know about. The people who subscribe stay ahead of the curve. The people who don't subscribe find out about these rules when their bank account comes up short. So hit subscribe and let's get to work. Let's start by shattering the biggest illusion in American retirement, the age 65 myth. For decades, 65 was the magic number. It was when you got your gold watch. It was when you got Medicare. It was when you got your full Social Security. But that world does not exist anymore. If you are turning 65 in the year 2026, you were born in 1961. And if you were born in 1961, your full retirement age, the age at which the Social Security Administration says you are allowed to work and earn unlimited money without losing a single penny of benefits, is NOT 65. Your full retirement age is 67. This is the single most important fact you will learn today. Age 65 is just the age you become eligible for Medicare. It has absolutely nothing to do with the Social Security earnings limit. Because your full retirement age is 67, if you are 65 and collecting Social Security, you are considered early in the eyes of the SSA. You're subject to the strictest, harshest version of the retirement earnings test. And what is that test? In 2026, if you are under your full retirement age for the entire year, you can earn up to $23,400 from your labor. That is your limit. You can make $23,400 and you keep your full Social Security check. But the moment you earn $23,401, the trap snaps shut. For every $2 you earn above that $23,400 limit, the Social Security Administration will withhold $1 of your benefits. Let me say that again, because the math is brutal. It is not a 10% tax. It is not a small deduction. It is a 50% marginal clawback rate. For every $2 you work for, the government takes $1 of your Social Security. Let's put this into real, hard numbers. Let's say you are 65. You are collecting a $2,000 a month Social Security benefit. That is $24,000 a year. You decide to take a part-time job, or you keep working your current job, and in 2026, you earn $43,400 from your work. How much are you over the limit? $43,400 minus $23,400 is $20,000. You are $20,000 over the limit. Because of the $1 for every $2 rule, SSA will take half of that excess. Half of $20,000 is $10,000. The Social Security Administration is going to withhold $10,000 of your benefits this year. Since your monthly check is $2,000, they will simply stop sending you your check for 5 full months. January, February, March, April, May, nothing. Your bank account will not see that direct deposit. You still get to keep the $43,400 you earned from your job. You just lost $10,000 of the Social Security money you paid into for decades. Now, I know what some of you are thinking. You are thinking, well, I'm making $43,000 from my job, and I'm only losing $10,000 from Social Security. I'm still coming out ahead. I'm still making more money overall. And mathematically, in a vacuum, yes, you are still net positive. But that is an incredibly dangerous way to look at it for 3 massive reasons. Reason number 1, cash flow destruction. You budgeted for that $2,000 a month. You have a mortgage or rent or property taxes. You have utility bills. You have grocery bills. When Social Security suddenly stops sending you that check for 5 months, you are not just losing money on paper. You are short on cash. You are putting your groceries on a credit card. You are taking out a high-interest personal loan to pay the heating bill. You are disrupting your entire financial life because the government decided to withhold your money. Reason number 2, the tax nightmare. When you do your taxes, you are still taxed on the full amount you earned from your job. The fact that Social Security withheld your benefits does not mean you get a tax deduction for the withheld amount. You are paying income tax on money you earned, and you are losing your Social Security benefits, and you aren't getting a tax break for the loss. It is a double hit. Reason number 3, the spousal trap. This is the one that ruins families. If you are 65, working and collecting Social Security, and your spouse is also collecting a spousal benefit based on your record, the earnings test applies to your spouse's check too. If you earn too much and your benefits get withheld, your spouse's benefits get withheld right alongside yours. You are now penalizing your husband or wife for your decision to keep working. So how do we avoid this? How do we navigate the $1 for every $2 rule when we are 65 and still working? The first step is understanding exactly what the Social Security Administration considers income. Because I promise you, they do not look at your total bank deposits. They do not look at your gross lifestyle. They look at a very specific, legally defined category of money. The retirement earnings test only applies to earned income. Earned income means money you receive in exchange for your current labor. It means W-2 wages from an employer. It means net earnings from self-employment. That is it. What is an earned income? This is where you can find some massive loopholes if you plan correctly. Unearned income does not count, not one single penny. Let's go through the list. Do you have a 401k or a traditional IRA? If you stop working, or if you reduce your hours, and you start taking monthly distributions from your IRA to pay your bills, the SSA does not count that against the $23,400 limit. You could pull $50,000 out of your IRA in 2026, and your Social Security check will not be reduced by a single cent. Do you have a Roth IRA? Same thing. Tax-free, penalty-free, and it doesn't count against the earnings limit. Do you have a pension from your former employer? Pensions do not count. Do you have annuities? Annuity payments do not count. Do you make money from investments? Capital gains, stock dividends, interest from your bank accounts, none of it counts. Do you own a rental property? If you are a passive landlord, just collecting a check from your tenant, that rental income does not count. Unless you are running a bed and breakfast and providing hotel-like services, but we will get to that later. This distinction is incredibly powerful. If you know that your part-time job is going to push you over the $23,400 limit, you have a choice to make. You can work those extra hours and let the SSA withhold 50 cents on the dollar, or you can stop working those extra hours and instead draw down your IRA to make up the difference. Let's look at the math on that. If you need an extra $10,000 to pay your bills this year and you earn it at your job and you are over the limit, the SA will take $5,000 of your Social Security. You did a lot of work for a net gain of $5,000, but if you just take $10,000 out of your IRA instead, the SSA takes nothing. You keep your full Social Security check and you still have the $10,000 to pay your bills. The money comes from your own savings, not from your labor, so the earnings test doesn't apply. Now, let's talk about how the Social Security Administration actually takes this money. Because a lot of people think, oh, I'll just wait until I file my taxes in April 2027, see what I made, and write them a check for the difference. No, that is not how it works. The SSA does not wait for the IRS. They apply the withholding monthly, and they do it aggressively. When you file for benefits, or when you report your expected earnings, the SSA estimates how much you will make. If they see you are going to be $20,000 over the limit, they know they need to withhold $10,000. How do they collect that $10,000? They don't take $833 out of your check every month. They just withhold your entire check until the debt is paid. If your monthly benefit is $2,000, they will just suspend your payments for 5 months. They will literally stop sending you money. This causes absolute chaos for seniors. I get calls on Seniors Radio all the time from people who are in tears because their automatic bill pay for their mortgage bounced, because Social Security didn't send their January check, and they didn't realize the earnings test was going to trigger a total suspension. If you know you are going to be over the limit, you need to proactively call the SSA at 1-800-772-1213. Tell them exactly what you expect to earn. Ask them how they will apply the withholding. If you have other sources of income, like a pension that can cover your bills during the months your Social Security check is suspended, you can plan for it. You can tell your bank to pause the automatic withdrawals. You can avoid the late fees and the bounced checks, but you have to be the one to manage this. The SSA will not manage it for you. Now, let's talk about a very specific, very dangerous trap for people who are 65 and still working, the self-employment minefield. If you are a W-2 employee, this is relatively simple. You work in December, you get paid in December, it counts for December. But if you are a small business owner, a freelancer, a consultant, or an independent contractor, the rules are completely different, and they are designed to catch you off guard. For self-employed individuals, the Social Security Administration does not just look at when you get paid, they look at when you perform the services. And more importantly, they look at how many hours hours you work. Let me tell you a story about a man named David. David is a listener of Seniors Radio. He is an IT consultant. He turned 65 last year, and he decided to retire. He worked incredibly hard in January, February, and March, finishing up 3 massive contracts for his clients. On March 31st, David officially retired. He closed his office. He stopped taking calls. He spent April through December playing golf and spending time with his grandkids, but his clients paid on net 90 terms. So, in May, he got a $20,000 check for work he did in February. In August, he got a $30,000 check for work he did in March. In November, he got a final $15,000 payout. At the end of the year, David's tax return showed $65,000 of net self-employment income. David panicked. He called me on Seniors Radio. He said, "The limit is $23,400. I made $65,000. I'm going to lose all my Social Security." But David was fine. Why? Because for self-employed people, the earnings test is based on the hours you work in a given month. Since David stopped performing any significant services after March, he was considered retired for the months of April through December. The SSA has a rule that says if you are retired in a given month, your benefits are protected for that month, even if your total yearly income is high, as long as you didn't perform significant services in that month. David was able to prove to the SSA that he didn't work a single hour after March. The SSA applied the earnings test only to the money he earned for the work he did in the first quarter, and they protected his checks for the rest of the year. But here is the trap. If David had just filed his taxes, seen the $65,000 number, and assumed he was penalized on the whole thing, he would have lost thousands of dollars. You have to actively report your retirement date to the SSA. You have to tell them, "I stopped working in March. The money I received in August was for work done in March." And you have to be careful about what significant services means. If you are a business owner and you spend 10 hours a month checking in on your employees, or reviewing the books, or meeting with clients, the SSA will say you are not retired. They will say you are still working, and they will apply the penalty. To be considered retired in a month, you generally cannot spend more than 45 hours working in that month, or if it's a highly skilled business, you can't spend more than 15 hours. You have to truly step away. Now, let's talk about the light at the end of the tunnel, because this $1 for every $2 rule is not forever. It only lasts until you reach your full retirement age. Remember, if you are 65 in 2026, your FRA is 67. That means you have to endure this rule for 2 entire years. But the rules change dramatically in the year you actually turn 67. Let's say your 67th birthday is in August 2028. For the years 2026 and 2027, you are subject to the strict $23,400 limit and the $1 for every $2 penalty. But in 2028, the year you turn 67, a special rule kicks in. For the months before your birthday month, the earnings limit jumps massively. In 2026, the limit for the year you reach FRA is $62,160, and the penalty drops from $1 for every $2 to $1 for every $3. So, in 2028, between January and July, you can earn up to $62,160. For every $3 you make over that, they only take $1. And here is the best part. This limit only applies to the money you earn before the month you turn 67. The moment you wake up on the morning of your 67th birthday in August, the earnings test is dead. It is gone. It is erased from the code as far as you are concerned. From August 1st, 2028 until the day you die, you can work. You can earn $1 million a year. You can win the lottery. You can sell a business for $10 million. The Social Security Administration will not withhold a single penny of your benefits. The earnings test only applies to the months before you reach FRA. This creates a massive strategic opportunity for people who are 65 and planning their work schedule. If you know you are going to reach FRA in August of 2028, you can try to structure your work life to push as much income as possible into the second half of 2028. If you are a business owner, delay your bonuses, defer your contract payouts, push your income into the months after your birthday, where it is 100% protected. But what if you don't want to wait until you are 67? What if you are 65 right now, you are working, and you realize, oh my goodness, I am going to hit the $23,400 limit, and I don't want the SSA to withhold my checks. What can I do? You have options. Let's talk about the strategies to legally minimize or completely avoid this penalty. Strategy number 1, the mid-year retirement grace period. I mentioned this briefly with David, the IT consultant, but it applies to W-2 employees too. The SSA applies the earnings test on a monthly basis if you retire mid-year. Let's say you are 65, you work a demanding job, you are exhausted, you decide you want to retire on June 30th, 2026. You work hard from January to June, and you earn $40,000. You are way over the $23,400 annual limit, but because you retired in June, for the months of July through December, you are considered retired. The SA has a special monthly limit for retired individuals. In 2026, that monthly limit is $1,950, which is exactly 1/12 of the $23,400 annual limit. If you are retired in a given month, and your earnings for that specific month are under $1,950, and you did not perform significant services for an employer in that month, your check for that month is protected. So you earned $40,000 in the first half of the year. The SSA will apply the penalty to those months. But for July, August, September, October, November, and December, you are retired. You aren't working. You aren't earning anything. Your Social Security checks for those 6 months will be paid in full. This is a beautiful loophole. It allows you to work hard for half the year, retire, and still get your full Social Security checks for the second half of the year without being penalized for the high income you earned in the first half. You just have to make sure you actually stop working and you report your retirement date to the SSA immediately. Strategy number 2, the spousal coordination strategy. I mentioned earlier that your earnings can hurt your spouse's check, but you can use this rule to your advantage. Let's say you and your spouse are both 65. You both want to claim Social Security, but you are still working and you know you're going to make $50,000 this year. Your spouse is not working. They are fully retired. If you both claim, your $50,000 income will trigger the earnings test. Your check will be withheld. And because your spouse is collecting a spousal benefit based on your record, their check will be withheld too. You will both get $0 from Social Security this year. But what if your spouse claims first and you delay your claim? If your spouse claims based on their own work record and they are not working, their check is completely safe. Your earnings do not affect your spouse's independent retirement benefit. Now, what about the spousal benefit? If your spouse claims a spousal benefit based on your record, that gets withheld. So the strategy is have your spouse claim their own retirement benefit. Delay your claim. And delay your spouse's claim for a spousal benefit on your record until you reach full retirement age or until your income drops below the limit. Social Security claiming is not just about looking at your individual check. It is about looking at your household as a single financial unit. You have to coordinate your claiming dates with your work schedule to avoid the earnings test trap. Strategy number 3, the retroactive withdrawal lifesaver. What if you already made a mistake? What if you are 65, you claimed Social Security a year ago, you kept working, you went over the limit, and the SSA just sent you a letter saying, you owe us $8,000 in overpaid benefits. You are panicking. You don't have $8,000 to give them. What do? There is a little-known rule called the withdrawal of application. If you filed for Social Security and you realize it was a mistake because you are still working and getting penalized, you can file Form SSA 521, request for withdrawal of application. If the SSA approves this, it is if you never filed for benefits in the first place. They will cancel your claim, but you have to pay back every single penny of benefits you have received so far. Wait, you say, I don't have the money to pay them back. Here is the magic. You can use the overpayment they are already assessing against you to offset the withdrawal. If you owe them $8,000 because of the earnings test and you have received $20,000 in total benefits, you can tell them, I want to withdraw my application. Take the $8,000 I owe you for the overpayment, and I will write you a check for the remaining $12,000. Once you pay it back, your claim is wiped clean. You are back to zero. And because your claim is wiped clean, you can reapply at a later date when you are actually retired or when you reach full retirement age, and your benefit will be higher because you delayed your claiming age. This is a massive lifeline for people who claim too early and are now being crushed by the earnings test. It allows you to hit the reset button. You have to do it within 12 months of your original claim, or you have to prove special circumstances, but it is an option that almost nobody knows about. Now, I want to address a question I get on Seniors Radio all the time. If the SSA withholds my money because I went over the limit, do I get it back? I touched on this in the last broadcast, but it is so important I need to reiterate it because there is a lot of false hope out there. Yes, the money is not technically gone. When you reach your full retirement age, the SSA will recalculate your benefit. They will look at all the months they withheld your money, and they will act as if you didn't claim during those months. They will increase your monthly benefit slightly to account for the late claiming. But listen to me very carefully. This is a terrible deal. First, it is an interest-free loan to the federal government. You are giving them your money today when you need it to buy food and pay the mortgage, and they are giving it back to you in tiny increments over the next 20 years without paying you a single cent of interest. If you invested that withheld money in a simple CD or a treasury bond, you would be earning 4% or 5% on it. The SSA pays you zero. Second, it destroys your current cash flow. A slightly higher check when you are 75 does not help you pay your heating bill when you are 65. Third, if you pass away before you live long enough to recoup the withheld money, it is gone. Your estate doesn't get it. Your heirs don't get it. The government keeps it. So, while it is true that the money is returned to you in the form of a higher monthly rate, you should do everything in your power to avoid the withholding in the first place. Do not rely on the recalculation. Plan your work hours, use your IRA withdrawals, utilize the mid-year retirement grace period, and keep your income under the limit. Let's talk about one more trap specifically for people who are 65 and still working: the interaction between the earnings test and taxes. A lot of people think, well, I'm only making $30,000 at my part-time job. I'm only $6,600 over the limit. It's not a big deal. But you have to look at the combined income. When you are working, you are paying payroll taxes. You are paying income tax on your wages. And if your combined income, which is your adjusted gross income plus non-taxable interest plus half of your Social Security benefit, crosses certain thresholds, your Social Security benefits become taxable taxable. For a single filer, if your combined income is between $25,000 and $34,000, up to 50% of your Social Security benefit can be taxed. If it is over $34,000, up to 85% of your benefit can be taxed. So, if you are 65, working and earning $40,000, you are not only triggering the $1 for every $2 earnings test withholding, but you are also pushing your combined income so high that the IRS is going to tax up to 85% of your remaining Social Security benefit. You are getting hit by the SSA withholding on the front end and the IRS taxing on the back end. It is a double taxation nightmare. This is why sitting down with a CPA who specializes in senior taxation is not a luxury. It is an absolute necessity. You need someone to look at your W-2, your IRA withdrawals, your Social Security, and map out a strategy to keep you below both the SSA earnings limit and the IRS tax thresholds. Let's bring all of this together. We have covered a lot of ground in this broadcast. We have talked about the brutal reality of the $1 for every $2 rule. We have talked about the age 65 illusion. We have talked about what counts as income, how the withholding works, the self-employment traps, the mid-year retirement grace period, and the withdrawal of application strategy. If you take nothing else away from this hour on Seniors Radio, I want you to remember these 5 core principles. Number 1, age 65 is not full retirement age. If you are 65 in 2026, your FRA is 67. You are subject to the strict $23,400 earnings limit and the $1 for every $2 penalty till the month you turn 67. Number 2, only earned income counts. W-2 wages and self-employment profits count against the limit. IRA withdrawals, pensions 401ks, capital gains, and rental income do not count. Use your unearned income to supplement your cash flow instead of working extra hours. Number 3, the SSA withholds monthly, and they do it aggressively. They will just stop sending your checks until the penalty is paid. You must budget for this, or better yet, plan your work hours so it doesn't happen. Number 4, the year you turn 67 is your freedom year. The limit jumps to over $62,000. The penalty drops to $1 for every $3, and once you hit your birthday month, the earnings test disappears forever. Plan your income to push as much as possible into that magic year. Number 5, if you made a mistake and claimed too early while working, look into Form SSA 521, the withdrawal of application. It allows you to hit the reset button, pay back the benefits, and reapply later when you are truly retired. Working at 65 is a testament to your work ethic. It is a sign that you are active, engaged, and contributing to society. But you must play by the rules of the system. The Social Security Administration is a massive bureaucracy. They are not going to look out for your best interests. They are going to apply the law exactly as it is written. If you earn over the limit, they will take the money. But now you know the law. You know the limits. You know the loopholes. You know the strategies. You have the power to protect your paycheck. Your action plan for today is simple. Step 1. Look at your birth certificate. Calculate your exact full retirement age. Know the exact month and year you turn 67. Step 2. Look at your pay stubs. Calculate exactly how much you are on track to earn in W-2 wages and self-employment profit for 2026. Step 3. Compare that number to $23,400. Step 4. If you are going to be over the limit, make a decision right now. Will you cut your hours? Will you shift to drawing down your IRA? Will you use the mid-year retirement grace period? Step 5. Pick up the phone and call the SSSA at 1-800-772-1213. Report your estimated earnings for the year. Get it on the record. Tell them exactly what you plan to make so there are no surprises. You have worked hard your entire life. You deserve to keep the money you have earned. Do not let a misunderstanding of the $1 for every $2 rule rob you of your financial security. If this deep dive on Seniors Radio helped you understand the earnings test, please do me a huge favor. Hit that subscribe button. Share this broadcast with your spouse, with your friends who are still working, with your bridge club, with your coworkers. There are millions of 65-year-olds out there who have no idea this rule exists, and they are going to get a terrible shock when their checks stop arriving. You can be the person who warns them. One conversation can save a family thousands of dollars. I am your host, and this has been Seniors Radio. Stay informed, protect your benefits, keep working hard, and I will see you in the next broadcast.